Good morning, everybody, and welcome to our fourth episode of our In the Know webinar series, where we showcase our investment solutions, introduce you to our portfolio managers, and shed some light on both the domestic and international markets. Today, I'm joined by our co-portfolio manager on our flagship equity fund, Daniel Masvosvere. Daniel is a CFA charter holder. He holds 2 master's degrees in law and finance. Before I hand over to Daniel, I wanted to shed some light on the latest ASISA stats to the period ending December 2023. If you ever look at the next slide, you can see that there's been an increase of 5% in assets under management from 3.5 trillion to 3.7 trillion. Whilst this looks very impressive, this is largely as a result of market growth. However, if you look at the next slide, you can see that quarter on quarter net sales have reduced by almost 50%. And we believe this is largely as a result of many investors sitting on their hands on the sidelines waiting to deploy capital into the markets post-elections. As you're aware, most of the world goes to the polls this year, and people are concerned about geopolitical risk. The next couple of slides, I want to just introduce you to why equities should form part of a well-diversified investment portfolio. If you look at this slide, it's very, very busy. I don't expect you to read each and every little block. What's important here is actual colors. You can see that the darlings over the last couple of years, 2020, 21, 22, and year to date, have been international equities, which have really shot the lights out. But interesting, you can see that different asset classes perform differently throughout the market cycle. So it's important to have a well-diversified investment portfolio, of which equities should certainly form a primary component. If you look at the next couple of slides, let's just delve into this a little bit deeper and show you how equities generate, inflation-beating returns. Over a 3-year period, you can see the darling over here has been property, believe it or not. Property has been a laggard for many, many years. However, over the last 3 years, it's generated an annualized return of 12.97%, outperforming bonds, cash, and obviously the all-share index. However, as you basically project this further out, you look at the next slide, over a 5-year period, you start seeing equities come into their own. Equities over here, the all-share, representing equities, has generated an annualized return of 9.68%, outperforming all other asset classes. And over here, you can see, interestingly enough, where over the 3-year period, property was the darling. You can see property has underperformed, generating an annualized return of negative 0.24%. And if you look at the next 2 slides, showing you a 10-year performance, you can see how equities have really outperformed, generating 8%. And then over a 15-year period, you can see fantastic inflation-beating returns. Just flick to the next slide. On the 15-year number, you can see that equities has generated 12.53% annualized over a 15-year period, outperforming both bonds, property, and cash. Therefore, equities needs to form part of a well-diversified portfolio if you are to generate inflation-beating returns. So without further ado, I'm going to hand over to our expert portfolio manager, Daniel, who's going to take you through the markets, and then we'll end off with some Q&A. Daniel, over to you.
Thanks, Steve, and thank you all for joining our webinar this morning. So I co-manage the Ashburton flagship equity fund. We're an SA-focused equity team, but we retain the capability to allocate capital offshore under Reg 28 as we see opportunity there. But currently, obviously, we see more opportunity within the local market, and that's going to be reflected in our portfolio. And I'll speak to some of that opportunity as we see it and the outlook for the local market. But I'll start off by giving you guys an overview of the global market and how that's sort of performed over the last while. So looking at the performance of global markets, you can clearly see there the US has led global markets, and within the US, big tech has been a key driver. If you look at the returns over the last year, 54% return out of the Magnificent Seven, and that momentum continues into this year. Some of the themes in that space are obviously AI, which is sort of expected to drive significant uptick in productivity across different sectors and the broader economy in the US. And you know, big tech, call it the Magnificent Seven, has given investors a way to bet on that. And that's been driving some of that momentum. The S&P 500, again, like I said, you know, a key driver of MSCI World, as the US obviously has the biggest weighting within that index. And so that's driven the global market. But looking at emerging markets, I think we're starting to see key markets finding a bottom here. So, you know, the Chinese market had a negative return of 18% of the last year. Still negative this year, but less so. So I think we're sort of close to or have found a bottom there. Brazil's an interesting one. They had an election about circa 12-18 months ago, and coming out of that election, you saw that market rebound quite strongly, returning 28%. And I think this just speaks to the potential for an election that comes or portends structural reforms in the economy as a potential catalyst, right? So we have an election coming up in South Africa in May, and to the extent that you know, election translates to, I think, positive structural economic reform, again, I think you'll see an uptick in investor sentiment and a turnaround in our economy. I'll speak to some of how the market in SA has historically performed during election years. Looking at the next slide, you can see here, you know, the direction of travel in terms of global flows. All roads pretty much leading to the US, with Japan and India also seeing positive inflows. The key point I want to call out here is, you know, valuations have tracked pretty closely the trend in flows, and so you can see all the markets that have had let's call it positive, significant USD inflows are trading at multiples in excess of 20 times. And so on a relative basis, in terms of valuation, those markets looking a bit stretched. If you look at our market and other EM, where you've seen outflows, you can see quite clearly they are trading at single digit multiples, and at 9.5 times, our market is trading below its long run average of just over 12 times. And again, so I think there's a compelling valuation argument to be made for the local market, and we'll speak to some of what we see as the potential catalysts in there and dive into some of the detail around the opportunities as we see them. If you look at the next slide, that paints that picture quite clearly for you. So if you look at the S&P 500 and MSCI World, the long run average is there on the right, 15.1 for MSCI World, 16.7 for the US market. And you can see quite clearly both those markets trading at a premium to their long run averages. You look at our market at 9.5 times, obviously trading at a significant discount to its long run history. If you look within the SA market, obviously the small to mid cap space is where we see quite a lot of opportunities, with quite a lot of companies trading at mid single digit multiples, providing compelling opportunities. Looking at the next slide. So again, you know, our market trading at a discount, you know, how much of that is justified or not? We've obviously seen let's call it significant outflows, net foreigner selling of SA equities. And you know, that is not without cause. So we do have significant macro challenges in the local economy. But the point I hope to land here is that these challenges are in themselves the opportunity, I think, for South Africa. And to the extent we can grasp that opportunity and start to see some traction on these challenges, it bodes well for the market. So, you know, consumer pressures, the consumer in South Africa has been under pressure over the last while. Part of that is, you know, rising inflation, which now seems to have peaked and has certainly started to trend lower. And historically high interest rates. If you look at the, call it last 10 years coming out of GFC, we saw a 475 basis point increase in the repo rate. Again, that's significant pressure for households in the South African market. On the infrastructure front, I think Transnet and Eskom have obviously faced significant challenges. So I think bottlenecks at the port have certainly not helped. If you think about mining companies trying to get commodities out of the country, our poor rail infrastructure, again, it's hard to get product to the port and out of the country. That obviously has a dampening effect on the economy. The chart in the middle there shows you the deterioration in volumes driven through rail, which is obviously more efficient than road, and a significant uptick in road freight there, highlighting again the breakdown at Transnet. Eskom load shedding, we had historically high load shedding over the past 12, 18 months. And the chart on the right there shows it quite clearly. Now, what's encouraging again is I think you're seeing lower incidences of load shedding, and it's speaking to the idea that the challenges I think turn into the opportunities here. On the consumer, how do we see the outlook? So I think the outlook is rate cuts later this year, like I pointed out, and I'll show a chart on this. Inflation has come off. Rates are yet to come off, and to the extent we see a reduction in interest rates, that will certainly be supportive. The other key point to call out on the South African consumer is the implementation of the two-part system does imply a bit more cash in consumer pockets at the end of this year, which should see an uplift in consumer spending into the tail end of FY24. On Transnet, I just want to call out here, we're seeing positive momentum on public-private partnerships. And more recently, you saw the announcement around public-private partnership around the operation of Pier 2 at the Durban port. There are other projects, or call it PPPs, in the pipeline around key rail corridors like NATCOR. And to the extent that we can land these, again, I think this will be quite positive for economic activity in the country. I've already called out the lower instances of load shedding again. I think we're seeing positive traction there. And then the other point to call out in infrastructure is there's a significant pipeline of projects. 170 billion rand of infrastructure projects are currently in procurement, and this is obviously government data you can verify. And I think this is positive to the extent we can land these again. This should see an uplift off the bottom that we've seen in our market, and I think the election could be a key catalyst for that. Turning to the next slide. Obviously, commodities are quite key for our economy, and the chart on the left here clearly illustrates the significance of commodities within our market. And as a commodity-driven market, it obviously matters to us what happens with commodity prices, and certainly for the revenue service in the country, this is quite important. And the trend over the last 12 months is obviously 18 months was, commodity prices came off quite a lot. And you can see here the metals index correlates quite tightly with the all share. And as commodity prices come off, that does imply some pressure on our local market. I think quite encouragingly, though, we're seeing that a lot of these commodities, certainly over the last 6 months, have found, call it a bottom. With most of the commodities certainly that we track up double digits off their 6-month lows. And to the extent we see this momentum maintained, again, it bodes quite well for our local market. Turning to the next slide. I think inflation and interest rates globally have peaked, and the next move is certainly down. And looking at our local market, I just plot here for you, headline inflation data against the call it repo rate, and you can see inflation has come off. Rates are yet to follow, but the expectation is in the second half of this year we should see rates trend lower, which bodes quite well for the consumer and I think overall economic activity. Turning to the next slide. Okay, so coming to our own sort of equity offering, one of the key things we want to call out is, at circa 1 billion rand in AUM and growing, we still have a significant advantage over peers with, let's call it, bigger amounts of AUM to deploy. So this chart here just highlights to you the liquidity constraint that anybody with AUM over 5 billion faces investing in the small to mid cap space. So to build up call it 2% position in a fund, which is where it really starts to get meaningful, would take anybody with AUM in excess of 5 billion over 50 to 100 days to build up a 2% position. And yet, with our sort of AUM, we can do that quite quickly. We actually have taken advantage of this advantage that we have, and I'll highlight some of that on the next slide. So I've spoken quite a bit about SA Midcap, and I just thought to sort of illustrate it quite clearly on the next chart, on the next slide. So if you look at the SA Midcap space, the question is there opportunity? If you look at the rating of the Midcap index of the long term, the average PE is about 13.3 times. And if you look at where it's currently trading, on the face of it, it looks fairly valued. But if you just peel that veil and peek behind it, there's quite a lot of opportunity here. Healthy, properly cash generative, strong balance sheets, companies with diversified earnings bases. DataTech is an example here, as a company that has most of its earnings in USD. But it sort of falls in that small to mid cap basket, trading at a single digit PE, significant. Show you here is top 5 overweights. All of them are trading quite cheaply, and interestingly, all of them have the capacity to pay out dividends. Some of them have actually implemented buybacks. So even as we wait for an overall re-rating in the basket, I think you're getting paid to wait, which is quite positive. And these are the kind of stories that we like to invest behind. The next slide further illustrates the point, right? So we see an advantage in the small to mid cap space over our peers. We're pressing that advantage, not for the sake of it. Like I highlighted to you, there's compelling reasons to do it. Part valuation, part just strong fundamentals in these businesses, which have proven to be quite resilient to the cycle. So our top 5 overweights, if you look at our fund, are in that small to mid cap basket. I've already highlighted DataTech as an example. But this is not to say we do not see opportunity in the large cap space, and where we do, we do again take exposure there, and we retain an awareness of the benchmark. We're not actively chasing it. So if you just look there at our top 10 holdings, you can see companies like Masvosvere. There's a compelling valuation case to be made there. It's a business that has gone through quite a lot of change over the last while. And you're seeing a cleanup of the portfolio, good cash return out of their holding in Tencent. A lot of that which is finding its way back to shareholders through a buyback. So again, we see good opportunity there, and we take a position. Within banking in South Africa, a lot of our banks trading at single-digit multiples. All of them paying healthy, high single-digit dividend yields. So again, you get paid while you wait, and you're paying a pretty reasonable and in many cases discounted valuation. I've already spoken to the opportunity within commodities as we see it, as they've come off quite a bit. It's given us an opportunity to build up a position in a company like an Anglos as an example. And then there are opportunities in the Rand hedge cluster. So a company like British American Tobacco at a really compelling valuation, but more importantly, you're getting a healthy hard currency yield and getting paid as you wait. So this just gives you a sense of how we see the opportunity set, and there's plenty in the local market that we can take advantage of, and hence the focus of the fund on the local market, even though we can allocate capital directly offshore. Looking at the next slide, I just thought to talk you through an example in the mid-cap space here that we took advantage of, that has since played out quite nicely. They don't all play out like this, but hopefully you get a sense of our process and how we think as a team. So, WBO, Wilson Bailey, construction company, well known in the local market. Had tough going during COVID, call it the pandemic. So you saw a downturn in revenue growth during that period. But this is not, this was not unique to them. I think other companies had a similar sort of trajectory during the pandemic. But coming out of the pandemic, they also had an Australian business which was quite challenged, and some investors actually felt they should have exited that quite a while ago. But the point to make is in 2022, they then make the call to exit that business. They take a significant provision of 1.5 billion to settle guarantee obligations there. The earnings in the business turn negative. The stock sells off, and it almost is driven to a point of maximum pessimism. And at this point, it gets quite interesting to us, and we look at it, we do the work just to understand what risk there was, if any, to the group balance sheet, which was in a net cash position. And the core remaining SA and Africa focused business post an exit of Australia. And doing that work, it was pretty clear to us that there wasn't any material residual risk to the group balance sheet. And what you would have post the exit of Australia was a strong net cash balance sheet, a growing order book in the South African business, a growing order book in the African operation as well. And what you're going to sit with is a clear market leader in the South African market with unrivaled scale to take advantage of opportunities in private and public sector. And I've already spoken to the potential for an uptick in infrastructure spend, and we've seen that already start to come through. So that allowed us to build conviction in 2022, and we built up a position again in excess of 100 basis points. And like I said, this wouldn't be something that appear with 10 billion of AUM would be able to do quite easily. And so we were able to do that, and post that, they successfully exited Australia. There wasn't any flow back to the group balance sheet. It's still in a net cash position. The order book is still growing. Just calling out the health of that order book, the order book as it sits today covers 137% of your FY23 revenue, which speaks to the ability of the business to sustain its growth going forward. Let's turn to the next slide. Again, I've spoken to the fact that we're SA focused. But within our portfolio, there's, let's call it a natural hedge. So our portfolio exposure to non-SA earnings is greater than 50%. And this is via, listed companies on the JSE that have material non-SA revenues and earnings. So that's the exact number is circa 57%. And like I said, I think we see on a relative basis a more compelling opportunity set, partly on valuation, and we can't ignore the valuation argument because we're a valuation-led franchise. And so again, we continue to deploy capital in the local market, even as we retain the capacity to and capability to deploy it offshore through our overall sort of Ashburton team. Turning to the next slide, I would just like to maybe speak to our track record and performance. So the Ashburton active equity product was restructured, let's call it a little over 2 years ago, and a new team was brought in, and I'm a key part of that team. And together with the team, we've been able to turn around some of that performance, and the next slide will speak to that. So where previously the fund was in the fourth quartile, since we took over, what we show you here is the cumulative performance of the fund. And the simple way to understand this chart is that a rand of your capital invested in the Ashburton Equity Fund over the last, call it 2 years, would have delivered you first quartile returns. And we pride ourselves in that, and we hope to continue this momentum and run rate driven by our process, our people, and the ability to be patient, which obviously is quite key in investing. And I think that brings us pretty much close to the end of the presentation. At this point, I think we can sort of hand back over to Steve if there are any questions on the webinar.
I think before we go to Q&A, just an observation is I've been in the business for just over a year, and certainly the performance has drastically improved. There's been some incredible changes that have been made to the actual equity fund process that yourself, Charles, Patrice have implemented, and that's obviously manifesting in good returns for investors. So we looking forward to that to continue, and hopefully, we'll start to see some meaningful inflows into the fund as we progress. I think rightly so, due to the performance that you guys have managed to, achieve up until now. We've got a number of questions that I think everyone on the call should remain on the call for, because these are really, really insightful. The first one is the S&P 500 had a 10% gain in the first quarter of 2024. I think I alluded to that a little bit earlier when I opened up the webinar today. It's been the darling asset class, the S&P, for the last couple of years. In fact, it's been the best in 5 years, this 10% gain in the first quarter of 2024, despite a hawkish Fed. And the US is proving resilient, creating 303,000 jobs in March, beating consensus forecasts by almost 100,000. The US economy seems to be in really good shape. Daniel, can you maybe just elaborate a little bit on that?
No, for sure. I think ostensibly it's quite clear that the labor market data in the US suggests that the US market or the US economy is in pretty decent shape. The unemployment rate is below 4%. The yield curve in the US is still inverted. Some would argue it's undefeated. So, but the reality is, on current data, that the US economy is in pretty decent shape. If you look at consumer data, though, consumer spending, the PCE in the US has trended lower, consistent with a slowdown in consumer spending. So, the outlook is later this year we should see rate cuts, and I think that's consistent with the slowing in the US economy. But currently, obviously, in pretty good shape.
There are a lot of questions being posted exactly on that point in terms of rate cuts. Is the Fed waiting for inflation to come into the target range of 2%? Do you believe before starting to cut rates? What are they waiting for?
So I think the US Fed has got a dual mandate. So part of it is maximum employment, and the other part is price stability. The inflation data suggests, obviously, off the peaks, inflation has trended lower, still above 3%. And I think, to the extent it drops below 3%, it will give the Fed, I think, a bit more room to start to look at cutting rates. The other part of it is obviously the supply and demand within the labor market in the US. And to the extent that shifts, the Fed may again have cause to look at rate cuts. So the current dot plot, or basically Fed projections, are that rates will be cut in the second half of this year, anywhere between 50 and 75 basis points.
Okay, then Daniel, a lot of the questions coming from the audience is obviously centered around interest rate cuts. I think the consumer in general, around the world, I suppose, in particular in Europe, maybe not so much in the US, but certainly in South Africa, under immense pressure in terms of inflation at almost all-time highs. And are we waiting for the Fed to start cutting, or do you believe that the SARB might move earlier and start to cut rates, despite the Fed remaining steadfast in their position?
Yeah, I think the short answer to that, Steve, is it's unlikely the SARB cuts before the Fed. They typically and historically, with good reason, have tended to follow the Fed. So I think it's unlikely that we see the SARB cut rates before the Fed. I mean, that has implications for the rand, etc. So yeah. I think it's unlikely, without getting too deep in the detail and the weeds here. But I think it's unlikely that the SARB will cut rates before the Fed does.
So we're at the mercy of the US and obviously the Fed, unfortunately. So that's obviously the feedback to some of the questions that have been posted. Yeah. And then just some other interesting observations. Typically gold as a precious metal and almost a safe haven asset, normally rallies when equity markets come off, and to the contrary, when equity markets rally, you see gold basically coming off. At the moment, we see gold hit an all-time high and equity markets, in the US continue to rally. Can you maybe shed some light on that, because that's certainly a misnomer.
Yeah, so gold's always an interesting one. I'm yet to meet somebody who's got a crystal ball to call it perfectly. But over the last, let's call it 18, 24 months, you've seen a disruption in the historically tight correlation, inverse correlation between the US dollar and the gold price. And part of that was driven by central bank buying. And more recently, I think what is driving obviously the performance in gold has just been speculation around rate cuts. Again, speaking to that historic correlation, high gold price, softer dollar, and obviously if you get rates getting cut, it does imply a softer dollar and potentially better gold price, or at least certainly gold holding steady.
Okay, and then just in terms of the fund that you're managing, so you've obviously got a bias towards South African market, but there's exposure, to your offshore markets. The US, you mentioned the Magnificent Seven have obviously run, relatively hard. What other markets do you believe are offering value at the moment? Many are looking at Asia, and perhaps even Europe, which is not doing well at the moment. What is your thinking around, those particular markets?
So I think one that I'll maybe just speak to is the Chinese market. There are different camps on this. Some look at it as completely uninvestable. But I think if you just look at the data in that market, I pointed out the fact it's trading that market on average. I'm talking about the index here, so the Hang Seng. You could get the DJ Shanghai index trading at single-digit PEs. More interestingly, if you peel the veil and you start to look at companies like Alibaba, Pinduoduo, Tencent, the proportion of, so if you look at their market cap relative to the cash on balance sheet, in some cases you have up to a third, up to 2/3 of the market cap represented by cash on balance sheet, which is just speaking to the fact that I think these markets have clearly been oversold. A lot of these businesses are very strong and improving fundamentals. So yeah, that's an interesting market. We obviously have exposure to that through Naspers process and Tencent, which has worked out quite well.
Okay. And then one of the last questions here is that I see the French are interested in purchasing our pay TV multi-choice. Why is this? And do we hold any multi-choice in the equity portfolio?
Yeah, so we don't hold any multi-choice in the portfolio and have not for a while. I mean, we had, I think, legitimate concerns around the fundamentals in the business. There's real competitive challenges from players like Netflix, which I don't think the company has quite the answer for just yet. So you obviously had challenging fundamentals in that business, which drove a lot of the derating. Like I say, a lot of that I think was legitimate, but I think it gets to a point where it was oversold, and an investor like the French Canal Plus had about 37% as a stake in the business already, and so I think it's part opportunistic, and then part of it is obviously a bet on Africa and the growth that this market should offer over the next 10-20 years as we see an increase in internet penetration rates, etc. So yeah, that's the short answer to that.
Fantastic. And then lastly, Daniel, I mean, obviously as a portfolio manager, maybe it's an unfair question, of the equity fund, where do you place your money over the next 5 to 10 years?
In the Ashburton Equity Fund. That's the simple answer.
We're hoping for that answer.
No,
okay,
fantastic. Thanks, Steve.
We're going to leave it at that. Thank you very much for everybody on the call for attending today. Please join us next month for our 5th episode in the series, and we look forward to hosting you then. And don't forget that you do qualify for CPD points. This has been just over half an hour, so that will qualify you for half a CPD point. Thank you so much for attending today's webinar, and we look forward to hosting you next month. Have a fantastic
Thank you for joining. Thank you.
Thank you so much. Until then, bye-bye.